Well, silver, as you and I are literally just about to break out above the handle, which at 40 or more would clearly break out. Taking that just from the technical aspect of that, you could argue from that formation minimally, and I say this minimally, and I'm watching myself say this, Elijah, thinking I can't believe Pete Grandich is saying this, but I think silver could be triple digits. That means it's going to go to $100 or more. And so I'm real excited here. People need to know it if they don't know me. I've never been a silver bug, but I really think the time has come, and I really, think it's well.
Silver's potential breakout isn't just wishful thinking, it's grounded in both history and hard numbers. A veteran market strategist and commentator explains that while he has long favored gold, his view has shifted dramatically. For most of his career, he considered silver second class compared to gold. But when silver dipped below $30 earlier this year, he flipped his outlook. Now, he's as bullish if not more bullish on silver than on gold. Here's why. Silver's long-term chart is flashing a rare setup. Technical patterns like the cup and handle succeed about 8 times out of 10, and the longer the formation, the stronger the move. Silver has been building one for decades. If it breaks decisively above $40, it could launch into triple digits, $100 or more. That would be a game changer. But this isn't only about technicals. The fundamentals are lining up too. Unlike 20 or 30 years ago, there's no longer an excess supply of silver. Industrial demand from electronics to solar energy keeps climbing. And while central banks haven't traditionally bought much silver, recent purchases from the Middle East suggest a shift may be underway. Add in the gold to silver ratio, which looks historically stretched, and silver appears deeply undervalued. The bigger picture? If momentum investors pile in, institutions will be forced to follow, and silver could finally step out of gold's shadow. That makes the metal one of the most compelling opportunities in today's markets. Before we dive further into the discussion on silver, market performance, and the deeper economic divide, don't forget to like this video, subscribe to the channel, and hit the bell icon so you're always up to date with the latest analysis.
So first, I still believe gold and silver are going higher, particularly silver, which is anybody that knows Peter Grandich from just past a few months ago say, did Peter Grandich just say he was bullish on silver? Because I always treated it as second class to the gold itself in terms of ownership. Not that you shouldn't own it, but, there's been people for silver for decades, and, it underperformed quite a period of time. However, early in the year when it got below 30, I flipped the switch and I became as bullish, if not more bullish, on silver and gold. And I'll touch on that in a moment. But the first important thing is, so earlier in the year, after owning gold for as cheap as $1,300, when it got up to its highs or within $20 of the highs, I made a decision that the major producers now could do better than the physical gold price. Plus, gold needed to go through a very long consolidated phase because of how fast it rose in the previous 12 to 18 months. So I went into the major gold producers. Then, when they did as well, and they're going to continue to do well, they're basically record amounts of free cash flow in the sense they're printing money. The bottom line then was, well, the next order of business is, you have all these folks on Wall Street telling us about AI and all these centers and all these needs. Well, they need 2 things. They need electrical power, which we have a huge problem. You know how I feel about the grid and the inability to deliver power. But it also is going to need a whole bunch of metals. And that's why, another metal that I like very much is copper. But there's been such a lack of worldwide exploration for these metals. The world has shrunk to where companies are willing to go because of economics and social and political causes. So I backed up the truck, so to speak, in the most riskiest of the type of stocks, what we call junior resource stocks or exploration stocks. But I want to say one thing about it. Gold and silver are just trading the best you could expect at this point in time. And as you and I speak, they're both on the verge to run, but the one that could really run, and again, I have to check my mouth that I'm actually saying this to you, I think silver is going to explode to the upside. As this chart I know you're going to show, going back 50 years in silver, there's been a 31-year formation of what we call a cup and then an 11-year handle. Now, if you remember a couple of years ago when you and I first started speaking, one of the bullish things about gold back then when it was under 2,000 was it had an 11-year cup and handle formation that was ready to be taken out. And cup and handle formations 8 out of 10 times break to the upside, not to the downside. Well, silver, as you and I are literally just about to break out above the handle, which at 40 or more would clearly break out. Taking that just from the technical aspect of that, you could argue from that formation, minimally, and I say this minimally, and I'm watching myself say this, Elijah, thinking I can't believe Pete Grandich is saying this, but I think silver could be triple digits. That means it's going to go to $100 or more. And so I'm real excited here. People need to know it if they don't know me. I've never been a silver bug, but I really think the time has come, and I really think it's well. And even to the point that in your business of ownership, not only would I consider 50% ownership in the physical ownership, I might even overweight it in silver right now. So I'm about as bullish as I've ever been, ever, in the combination of both gold and silver. Probably 50-50, Elijah. I think the fundamentals are clearly better. See, there was always an excess 20 or 30 years ago. There isn't that excess now. And the other thing is it has so much more demand and usage from an industrial usage. It's still not a monetary. I know a few people are trying to argue that. The central banks are not buying it in any large quantity, although out of the Middle East, we've seen a significant purchase, and that may be changing. The ratio is another reason it got way out of whack. Not that it has to be any certain ratio, but if you're going to use historically, it seemed to be favorable. And then it's just that chart. I mean, that chart, there aren't a lot of technical charts that have outstanding 8 or 9 out of 10 times it works a certain way. Cup and handles, especially the longer they are, have about an 80% correlation of that when it breaks the handle to the upside, they go up substantially. So all those things combined, and throw in the fact that the things that have been competitive against gold and silver, the stock market and crypto, they look like they're peaking. So 12 to 24 months out, they could be in a much better environment than they did previously. And I will tell you this, if we're right about the technicals, I'm not saying it's gonna, but if we're right, we're going to see momentum players show up. And when momentum players show up and the charts really take off, then all these generalists are going to get calls from their institute. How come we don't own any silver? What can we own? And you know how I know that? In the last 3 weeks, maybe the whole month of August, I heard from 10 people that I haven't heard from in 10 or 20 years. In fact, they thought I was already out of the business because I left the metals and mining business in 2013. But they saw me somewheres and all, and they're starting to go, hey, I'm starting to hear from people that know what they're talking about. What are you looking at? And I just think if we get this breakout and it's being talked even in the general financial media, the fundamentals and the supply and demand argument is so bullish. So that's why I'm so optimistic.
At the beginning of the year, the expectation was that markets would remain relatively stable, with the Dow and S&P 500 likely ending the year close to unchanged, perhaps within 5% in either direction. This outlook stood in contrast to forecasts of a sharp 20% decline or an outright crash. There was also an anticipation of stronger performance from markets outside the U.S., particularly China and emerging economies, which so far have delivered, significantly outpacing American equities. Gold and silver have also far outperformed, yet mainstream financial media continues to focus primarily on Wall Street, creating the impression that U.S. stocks have had an exceptional year when the broader reality tells a different story. Adding to this is the issue of wealth distribution. The wealthiest 10% of Americans now control 86% of all assets, while the next 40% hold about 14%, leaving the bottom half with virtually nothing. Wall Street caters almost exclusively to this wealthiest group, with only lower-tier advisors occasionally working with those in the 11 to 50% range. In practice, the financial industry functions to serve the top slice of society, reinforcing the divide between record market levels and the struggles of most households. Let's get back to the interview.
So I began the new year as a forecast saying that when the year was over, the Dow would be either side and the S&P of unchanged, maybe 5% one way or another. So I was not in the camp of people that were going back then and even before looking for, a crash or an extremely hard fall more of 20%, which would signify a bear market. However, about 2 weeks ago, somewhere in the middle of August, that changed. And it got to a point where I said, while I still believe the rest of August it can go higher, that after Labor Day, I think it's time for people to get in a much more defensive position. There are a lot of reasons. I'm sure you've heard from other guests already. Valuations at their highest, speculative levels showing people's excess. We have the public record buying of stocks, while large so-called, I don't know if you want to always call them smart money, but certainly large institutions are being major sellers. I've never seen in 41 years the public beat out the institutions over a long period of time. And they tend to be the last one in bull markets. There's a whole bunch of other reasons going back to this trade war, which, if you think about it, and people would just move away from the lapdogs, how I describe some of the people around Trump, there's been no real success on the trade war, no matter what anybody tells you or tries to make. If you remember all the promises, 90 trade deals in 90 days, all these people were going to be at Trump's feet. And other than the European Union, which hasn't even moved forward to formally do theirs, now we have the Japanese backing out, the Chinese are not going forward, India's turnaround. And so there's a lot of economic evidence that we are heading into a much more challenging time when stocks are at record levels. A country like China that I thought would outperform the U.S., and both of those have greatly outperformed the U.S. stock market. You know, there's a lot of excitement now, and I know I'm going on here, but because we went down sharply briefly in April and had this rally, there's a sense that this has just been a magnificent year. But right now, the U.S., despite all of this, has not been able to outperform world markets, emerging markets, China, and best of all, it's not even come close to gold and silver. Yet, if you turn on a financial network, that's all they talk about is the U.S. market. So all of that led to this belief, but because the last 2 weeks in August tend to be extremely seasonally bullish, because people are taking their last of their vacations and all, I said not to worry about a defensive position until after Labor Day, which ironically, we begin one of the more seasonally weak periods for the stock market, September into October. So all in all, I think it's the greatest minimum now. You need to be much more concerned about the U.S. stock market now than you might have been a few weeks ago. So we have what is commonly known as a K economy. First of all, the 10% wealthiest people in America own 86% of all the assets. The next 40% own about 14%. And the bottom 50% don't own any. Now, Wall Street basically caters to that 10%. I mean, the lower echelon of advisors, people that don't manage a lot of money and all, they'll deal with that 11 to 50% people that have some assets. But Wall Street talks to that group. Now, that group at the top is not hurting. In fact, they have benefited greatly by the way the country's been run and markets in that general. But the rest of the group, especially the bottom 50%, we have 2/3 of Americans working paycheck to paycheck. And in just the last couple of years, they have seen just about everything they need as a necessity go up in double digit.
Financial markets may appear strong as they hover near record highs, but the surface strength hides a deeper divide. A growing share of the population is weighed down by rising living costs and limited access to real wealth-building opportunities, even as asset prices soar. It's an uncomfortable contrast. Headlines celebrate resilience, yet for many households, stability feels increasingly out of reach. The imbalance points to fragility at the core of the system. A growth story that overwhelmingly benefits only a narrow slice of society raises questions about how sustainable it really is. The widening gap between financial markets and everyday realities suggests that what looks like progress may, in fact, be masking vulnerabilities few want to confront. The implications extend beyond domestic concerns. With global uncertainties compounding internal pressures, the outlook becomes even more complicated. What emerges is not the seamless strength portrayed in mainstream narratives, but a system struggling to balance optimism with underlying strain. The next phase for both markets and the broader economy is less about unbroken growth and more about navigating a period that could prove both more complex and more turbulent than many are prepared for. If the strength of the financial system is increasingly concentrated in the hands of a small minority, what happens when that imbalance collides with the growing economic strain felt by the majority? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.